Hi everyone, this is Steve Elwell, Partner, Chief Investment Officer of Level Financial Advisors, and this is your first quarter 2026 market commentary. The investment markets started off the year in January and February with a nice move upwards, only to have the end of the quarter upended by the start of a geopolitical conflict in Iran at the end of February that sort of pulled back all the stock market and even some of the bond market's gains for the quarter. We had the U.S. stock market ending the quarter down 3.96%. International stocks and emerging market stocks were also down, although quite a bit less than that. Global real estate was actually positive for the quarter by 0.77, and even the bond market was slightly negative for the first quarter. Although the story, that doesn't really tell the full story. There was a really large deviation, and this happens from time to time, but a really large deviation in growth stocks versus value stocks, large stocks versus small stocks, U.S. stocks versus international stocks. I mean, there was no better quarter to be diversified in the last few years than this first quarter of 2026. So here's a little bit of a visual that helps illustrate that. On the top right of this slide, you'll see that this is just in U.S. stocks, U.S. small cap value was actually positive by 5% for the quarter. U.S. large cap value positive by over 2%. Small cap stocks in general positive by almost 1%. But you start getting into the growth categories, which are usually pretty heavily in technology, and U.S. large growth really leading the pullback at negative 9.78% for the quarter. So these are the world's largest tech companies, the ones mostly involved in artificial intelligence and production of chips used in supercomputers. And it's really kind of all the stuff that was super hot and super hyped, which is not shocking, right? Things that have had huge gains also tend to be things that in a serious downturn tend to give back the largest amount of gains, and that's exactly what happened here in the first quarter. So a really wide deviation between different types and categories of the U.S. stock market, and the same could be said for overseas. Actually, emerging markets, really, of the bunch, ended up doing really well in the first quarter as well, specifically because some of the semiconductor companies that are located in places like Taiwan were really moving forward and having a great quarter, even considering the downturn that happened in March. So for the quarter, really a pretty wide deviation between big U.S. stocks, big U.S. tech companies, and just about everything else, which actually I think for a lot of client portfolios helped translate into hopefully what people perceived as, better than expected results for the quarter. I mean, if you just watched the headlines and didn't look at your portfolio at all, you would have thought, what am I going to be down here? 2, 3, 4, 5% for the quarter. And for most clients, it wasn't anywhere near that. And for a lot of clients, actually slightly positive returns for the quarter. That coupled with our relatively short-term, high-quality bond exposure in our portfolios, really kind of across the board, helped us in terms of avoiding larger declines than what could have happened in the first quarter of 2026. This next visual is from our friends at DFA, and it does a good job really reiterating that, number one, geopolitical risk is not something that's new. We face different scenarios, some unexpected, some somewhat more expected, or at least with some types of heads up, that ultimately provide a little bit of a shock to the investment markets. But as time goes on, whether it's 3 months, 6 months, 1 year, 2 years later, many of the times the markets are able to absorb that, surprise event or unexpected event and ultimately refocus on what investing is, which is putting capital to use and hoping for a return lending that capital to companies that are trying to use it to produce goods and services that they sell for a profit and return some of that profit to you, the shareholder, you, the investor. And if they're doing that successfully, even if there is a conflict happening overseas or some surprise event geopolitically happening throughout the world, they're still trying every day to do the best they can to turn capital into profits. And so, one of the very simplest examples that we've been using in the first quarter is, and this is not to trivialize exactly what's happening. I mean, we don't want to minimize the severity and importance of what's happening in Iran from multiple angles. But what we do want to point out from an investment standpoint, if you're talking about your portfolio, is that are less people, shopping at Target because of the geopolitical conflict? And the answer is probably intuitively no. That people haven't changed their day-to-day spending, even though the headlines are extremely concerning. And this visual goes all the way back to 1970. So we're talking 55 years of major market events, many of which were geopolitical events. The Iraq War, when Iraq invaded Kuwait, the Arab oil embargo back in the 70s, the Russian financial crisis in the 90s. You have all sorts of different geopolitical events that have happened on this chart. And if you zoom out and look over that time frame, now don't get me wrong, looking at a 55-year time frame, right? It's easy to do with our eyes, hard to do in real life. It's hard, we think in minute to minute, second to second, not, what's the next 50 years? But the path and evidence is, really overwhelming that the investment markets have continued to progress and move higher over that 55-year time frame, despite all sorts of things to worry about. I say it all the time, the old Wall Street saying is that stocks climb a wall of worry. There is always something to worry about. Some seem certainly much more concerning than others, but there is always something going on. What you're not seeing is what I referenced earlier. You're not seeing that a small technological breakthrough in this industry meant that all these companies that played in that field were going to be able to be slightly more profitable, or that XYZ company had a really great quarter despite this backdrop of geopolitical risk, or despite tariffs being implemented unexpectedly and at a higher cost. Despite all the other things. And what I always try to remind people too is, and it makes so much sense when you say it out loud, but you don't think about it in most days, is that of course every day that goes on, employees, managers, executives at all of the world's companies, if they're doing their job, are going to work to try and get a little bit better every day, to figure out how to make better products or better services, to figure out how to be efficient in what they spend on their costs. That kind of goes almost without saying, but sometimes we forget to say it. The slow progress, the very slow progress of increasing efficiency and productivity and getting a little bit better every single day results in, on top of just simply also inflation, right? If you're selling $10 million of something 1 year and inflation is 2% and your price increases reflect that 2%, then you're selling a little bit more next year. Or if you were able to reduce cost, then maybe you end up turning a little bit more profit. There is this constant creation, improvement of processes, of products, of services. So these companies and people are doing that every day. And that doesn't go without some level of success, right? It doesn't mean they're actually making great progress every day, but sometimes they make great progress in a very short period of time. It'll be very interesting to see for a lot of companies if AI actually ends up being something that helps workers become more productive or companies become more productive. There's a labor concern on the other side of that as to are certain jobs going to be replaced by AI. But I think more and more as time has been going on here, we're starting to see that companies are actually, yes, implementing it, but also recognizing that they still need people to oversee it, implement it, use the information the right way, make sure it works the right way. So, that's kind of almost a whole different conversation. But my point here is that there's nothing that tells us in long-term stock market history that you should make some wholesale change in your portfolio when some unexpected geopolitical event happens, because there's no evidence that that would have a long-term effect. And when I say long-term, I mean like years, decade beyond, that there's going to be a negative effect, and that's going to stop the stock market from having the ability to grow. And we have some other visual ways to show that. So, what has the last 24 major geopolitical events since 1960 shown? Well, according to this slide from Vanguard, who put out just a whole host of great information in March about stock market returns, bond market returns during unexpected events like this. The average stock market total return 6 months after the start of an event was a positive 5%. That was the average. The average 1 year total return after the start of an event, 8%, which almost exactly matches the range of the long-term stock market annual average. And so we're talking some serious events here, right? We're talking the Soviet invasion of Afghanistan, the Cuban Missile Crisis, the Iraq War, non-battle war related things like Brexit vote that happened in 2016, which was a total shock, Russia's invasion of Ukraine in 2022, and then there's another 16 events that are not shown visually on this chart. They pulled out those ones to show them individually. But another 16 events beyond that. And so we just don't have evidence that tells us that, oh yes, you should cash everything in and sit on the sidelines for the next 5 years or 2 years or 1 year even. Comes with substantial risk, opportunity risk of what you might miss out on if you don't just stick with it, if you don't remain disciplined in your investment strategy. And as much as I sort of hate to say it, sometimes people will say, well, nobody could have predicted this, and we don't know how it's going to resolve or if it'll resolve or how fast it'll resolve. I mean, people want certainty in moments of uncertainty. Well, of course they do. But no one on TV or any pundit or any government official or anyone else really is going to be able to tell you with direct certainty and predictability that, this is going to happen, right? If we just wait a month, then okay, everything will be fine after that. Or if we wait 6 months, everything will be fine after that. Everybody is operating in a scenario where the short term is unpredictable. And if you think you're smarter than what the market is going to implement as news unfolds, or you're going to be able to predict something that is not predictable, that you're playing a very dangerous game that you are extremely unlikely to win. Not only are you unlikely to win, you actually have to win twice. You have to sell before the downturn gets worse or starts. And then you also need to buy back in before the recovery happens, because of course if let's say the Dow's at 50,000 and you sell and it goes down to 40,000 and you sit there and say, well, I'm a genius, look at me, and then it climbs back to 45 and you say, no, this recovery is not real, I don't believe it, and then it gets back to 50 and you still say, no, this is not real, I don't believe it, I still think bad things are coming, and then it climbs to 55,000 and you give up and buy back in, you got the first part right, but it didn't matter because you got the second part wrong. And so you're trying to get both things right to be successful, because if you just get one of them, that's not going to help you. And so that's extremely difficult, and also is playing a game that no one consistently has ever won. There's no evidence that anyone has ever been able to short-term time the market. So it's a really dangerous move to try and do that. And I would add, when people say, this unexpected event happened and I don't know how it's going to play out and I feel like I need to do something, to remind ourselves that every year something unexpected happens. Multiple unexpected things happen that affect the investment markets that have nothing to do with like IBM's earnings. That have to do with something that's much bigger than that, like trade policy or geopolitical conflict or any other host of bank crisis that like happened in spring of 2023, or hyperinflation, or any unexpected thing that can cause markets to have a pullback or downturn. On average, the stock market has a 10% decline at some point in just about every single year. And the decline that we just had in the S&P 500, at least in the first quarter, or I really should say March, from the end of February to the end of March, was essentially that. And we sit here and say, oh my goodness, this is terrible. We need to make some huge change in the portfolios as a result of this. This isn't, maybe what is causing it to go down might be a surprise, but that the stock market itself is having a 10% decline at some point, especially in the backdrop of the last 3 years where the investment markets have been phenomenal. I mean, absolutely phenomenal. You could have closed your eyes and thrown darts at the Wall Street Journal stock ticker list and probably made a bunch of money in the last 3 years because of how much the markets have gone up without any skill at all, just pure luck. And to say that's a 10% pullback all of a sudden is some totally unbelievable abnormal event is dead wrong. It's an expected event once per year, sometimes more than once per year, but on average once per year. I framed it in a way that type of volatility is not a bug of the stock market. It's a feature. It's what happens. It's what you should expect. In fact, you should expect 1 out of every 3 or 4 years probably to be negative for the stock market if you're looking just simply over a 12-month period, or January 1st to December 31st. That doesn't mean it's definitely going to happen, but it would be totally normal to have that happen. And so I think if the more that you can accept that the volatility in the stock market is the reason that the stock market's long-term returns are better than cash, better than treasury bills and CDs, better than government bonds. The reason that those returns are higher is because you have to be compensated to put up with all that. And you should be. Otherwise, why would you do it? You would never do it. If the long-term stock market returns were 4% with 20% standard deviation volatility every year, and the long-term returns of US T-bills was 4% with very little deviation each year, you would never buy stocks. Why would you? Why would you take the extra risk to get the same return? So, I mean, that context, it should be built into your framework of expectations. And I know that's hard to accept, right? It's hard to accept that in some given month you might get a statement or a couple of statements in a row, or a whole 6 or 8 or 9 month period in a row where it just feels like the market's either going nowhere or just kind of bleeding its way down. And those are the moments where you earn your money. Because if you stick with it, as evidence has proved, as history has proved, if you are able to stick with it, the longer you can stick with it, not only the more likely are you to make money investing in the stock market, but you're more likely to make a lot of money in the stock market the longer you can end up sticking with it. And this next visual from Vanguard is a great example of that. The what I'll call is kind of like yellowish, bronzish lines or visuals on this chart are stock market downturns, bear markets from going from 1980 all the way through 2024. So, 44 years worth of data. And yes, there's been 12 bear markets defined as a decline of 20% or more during those time frames. And also this is showing not only the depth of how deep was the decline, but also visually the length of how long the decline was, which is on average 282 days, which is less than a year from start of the decline to recovery. But also showing next to that the total returns on average of the bull markets, which are defined as obviously good times, and the average length of those bull markets, which is approximately 3 years, and 96% over those 3 years cumulatively. So these turquoise-ish colors on this chart is showing you that you can easily see that the bull markets tend to be longer and much larger than the bear markets. They're more frequent, they're longer, the amount of money you make is more than what you give back in the temporary times when the markets are struggling. And if you can just hold on through those struggling times, then you get the reward of all the turquoise colored bull market times, which is where all the money is end up being made. So that's one way to show it. The other way, another argument against actually making any changes to your portfolio when things get scary, headlines get scary, and you hear noise all over the place from people screaming from the mountaintops that you should be selling your stocks and moving to the sidelines now and put your money in cash. It's the only safe thing out there. Well, the real reality is, and I love this type of data or analysis, is that, again, I already mentioned timing the market is extremely difficult. You got to be right twice. You got to know when you got to sell before it goes down, and then you got to buy before it fully recovers, which is very hard to do. But even if you're moving to the sidelines, the worst trading days, or the biggest down days, and the biggest up days are always bunched together. They always are happening at the same time. April of 2024, 25, with the tariff announcement that came on Liberation Day, is a perfect example. It's still somewhat fresh in people's minds because it was only a year ago. But what happened during that? There was this announcement that tariffs were larger and wider than what we thought they were going to be, or the market thought they were going to be. Markets sold off aggressively. I mean, like 5% down, 6% down on one day for the S&P 500. And then a week later, with a tweet, all of a sudden, markets shoot up 8% in one day because they say, oh, we're going to delay the implementation of all this for 90 days. And then ultimately, that 90 days gave all sorts of different negotiations to happen where most and a lot of those tariffs either got greatly reduced or went away. And so in that 7 to 10 day period, you had huge swings up and down. And imagine how you would feel if you sold on the day it was down 6% and then the next day it was up 8% and you missed out on that. So even a couple of days of being out of the investment markets could be extremely risky from a financial perspective. It's always, and the framework always sort of comes from, I have to protect what I have. I have to protect my capital, protect my nest egg from further going down as a result of whatever's happened. And that gives really no consideration to the opportunity risk of what you will miss out on if you go ahead and do that. If you're wrong, it's not just that markets maybe stay where they are and you didn't avoid a downturn that you thought was coming. But if you're wrong, it's also very possible that markets recover while you're on the sidelines and you miss out on that. And now you have a really difficult choice. You're faced with a choice to sort of, eat face and say, okay, I was wrong. I cost myself a bunch of money, but now I got to get back in, because what if this recovery continues, which most of the time it does? Or even worse, say, I don't believe this recovery. Market's just going to, come back down, and I'll buy back in then. And now you're sitting and waiting and waiting and waiting. And if the market's continuing to go up, you're feeling worse and worse because you know you've cost yourself more and more money. It's a vicious cycle of, what do I do? Because I've already made a bad choice. I now recognize I've made a bad choice. And my two options are either take more risk by staying out on the sidelines and potentially even have prices go higher, or just eat face, like I said, and buy back in, and really at that point basically lock in that you have cost yourself money because you sold low and you bought high. You did the exact opposite of what you were supposed to do. So I always like to point out that, of course, and it makes total sense why the biggest down days and the biggest up days are always bunched together. It's because some unexpected, hugely impactful piece of news, or at least perceived to be hugely impactful piece of news, has come out of left field that the markets were not predicting was coming, caught the market off guard, and now what is happening? Millions and millions and millions of investors across the globe are trying to figure out, what impact will this have? And so you have some who just say, well, I'm not sure what the impact is, but I'm selling. And so you have a lot of pressure on the downside. And then as time goes on, people start to get more information, more news, more details come down the line, and the market really starts to price in, what is the impact of this? And oftentimes, if some of that original concern alleviates for whatever reason, then you see a recovery. And so, of course, if the market is trying to digest a huge piece of new information, that you're going to find the most volatile days all bunched together, both up and down. And so that further increased the risk if you were going to move to the sidelines. And the last visual I'm going to show here, it really puts numbers on that. I mean, Vanguard did a great job here of putting numbers on that. And they're essentially showing that for a normal 60% stock, 40% bond portfolio, that moving into cash, the longer you're sitting in cash, the more likely you are that you are going to underperform had you just sat still and did nothing. Even 3 months, 74% of the time, you would underperform a 60-40 portfolio. And the average underperformance would be 4.1%. If you have $1 million portfolio, that cost you $41,000 for 3 months. If it's 6 months, 71% of the time underperforming at 7.4% on average. If it's a full year, 87%, 13.3% average underperformance. Back to $1 million portfolio, you just cost yourself $133,000. Because apparently you thought that it was able to figure out that the markets were going to go down and continue to go down. Even in that scenario, that could be someone who sells in a panic, markets start to recover, and then just gets frozen. Frozen because, back to the scenario I just played out, you either have to admit you're wrong and buy back in, which is painful, or you're sitting there saying, well, I think it's going to pull back and I'll wait for a pullback. And you keep waiting and waiting and waiting, and the pullback doesn't happen. And it's 12 months later, and you've cost yourself a huge amount of money by doing that. And so, it's not that myself or anyone else, knows with certainty how fast something is going to recover or that things are going to immediately bounce back. I mean, we've all been fortunate that, the last few big downturns actually have bounced back relatively quickly. I mean, within a matter of months. I mean, March 2020, even the downturn in 2022, I mean, dragged into the summer, but by the time it got out to the fall, the recovery was underway. And then this most recent one of April of 2025, I mean, that was a matter of weeks. So there is real risk of moving to the sidelines. And I mean, if you think about it in terms of, I don't really ever advocate for doing this, but in terms of a gambler or a casino, if a casino had a house game where they had an 87% chance of winning on any given roll of the dice, I mean, jeez, you would always take that. You'd always take those odds as long as you could stick it out so the averages actually play out. You would always take those odds. So I'd just like to emphasize, really the dangers of moving to the sidelines or making portfolio changes, even during concerning times, what feel like unprecedented times, or, just simply out of fear that you've spent your life and decades building a portfolio that now you're approaching either retirement or already in retirement and living off of, and you can't afford to have huge losses that never recover. And it's hard to accept that while we believe it's going to recover without a definitive, the recovery is going to start next Tuesday or a month from now, without that definitive, here's when it's going to actually start, it feels like you're just floating in the wind. And would totally empathize with that thought and that concern. But we also know that the evidence is overwhelming that the stock market is kind of like a roller coaster, and that when you're on the ride, don't get out of your seat. That's a dangerous move. The only other thing I'll add, and I'll end on this, which I normally don't do, but this is being recorded on April 22nd. So of course, I have a fair amount of information as to what has happened after March 31st. And everyone's statements from Level are as of March 31st. And the April statements from Schwab are not out yet because, of course, April's not over. And there's still, a week here to go of what might happen in the markets. But at the current moment of this recording, the global stock market is now up 6% year to date. The S&P 500 is up 4% year to date. Keep in mind, back on that first slide we showed, the S&P 500 was down 4% for the quarter. And now we're up 4% as of April 22nd. So that gives you an idea of what type of recovery has already happened. We are essentially at all-time highs again. And so I'll sort of leave it with that. That doesn't guarantee that markets are going to keep moving forward or anything like that, or that there may not be, it doesn't guarantee that markets might not pull back again or anything like that. I'm not saying that. I'm just saying that it's literally only been 3 weeks since the end of March, and here we are, and things have already not only turned a corner and recovered, but now we're at new all-time highs. And there, again, is a good reason for that. That looks like there's some progress on hopefully ending the conflict in Iran. But beyond that, there's also been a bunch of good reports from publicly traded companies that have earned more money than we thought they would and have given really optimistic guidance about the rest of the year. And the end of the story is, when you're investing in stocks, is how much money they make is the main driver of their return. And so, of course, getting good news on that front will usually cause the stock market to go up. So I'll end it with that. I really look forward to talking to everyone next quarter to see how things sort of continue to unfold here. Obviously, like I said, it's only mid-April, so we've got a ways to go before the end of the second quarter. But we thought we'd give a lot of nice visual and historical context to how geopolitical events matter to markets and the impact they have in the short term and the long term. And again, I'm Steve Elwell, Chief Investment Officer with Level Financial Advisors, and I look forward to talking to you again in a couple of months.